Cashflow Diary Podcast, episode 546.
Welcome to yet another exciting episode of the CashFlow Diary Podcast, the podcast that teaches you insider tips, tactics, and strategies for creating leverage streams of cash flow into your life. Learn from top-performing entrepreneurs, business owners, investors, and thought leaders from across the globe as they share their secrets to success. Like what you learn on this and other CashFlow Diary podcast episodes? Go to learninvestingnow.com and sign up to receive powerful tips and information that will help you succeed as an entrepreneur and investor. Now, here's your host, investor, entrepreneur, business owner, educator, speaker, author, and master facilitator of Robert Kiyosaki's cash flow game, Jay Massey.
All right, ladies and gentlemen, welcome to another episode of the Cashflow Diary Podcast. I'm your host, Jay Massey, and I'm glad that you are here today because we are going to talk about that thing that I know many of you have said. Some of you have said that, you know what, Jay, I would do more real estate if I just had the money. I would do bigger deals if I could just find a way to get this particular apartment complex done. I would do all of these things, but there's no money out there. And you know what? Today's guest would say, no. There's plenty out there. You just don't know how to find it all the time. And so therefore, we're bringing you an individual who does exactly that. Literally, he's going to show us the money. I have with me today none other than Adam Finkel. He is the founding partner and principal at Tower Capital out there in Phoenix, which is code for really, really hot place during the summers. And they are a commercial real estate finance firm. So for those of you who have always said to yourself, I want to do the bigger apartments, I want to make something bigger, better, badder happen, but I just don't know who to talk to. Well, congratulations. You've chose this episode and you have chosen well, because we're going to ask him a whole bunch of questions. So here's what's going to happen. We're going to listen. We're going to learn. We're going to fall in love with the ideas and understanding that he'll be able to bring to the table. But most importantly, I want you to be ready to take action, because at the end of the day, nothing is going to change until you do. So let's get ready to listen, love, and learn from Adam Finkel. Adam, how you doing?
I'm doing well, Jay. Thanks for having me on. I'm very excited to be here.
I am glad that you are here too, because I get the question all the time. Jay, where's the money? I need more money. I would totally buy that place if I just had the money. So we're going to talk about all those types of things. But this being the first time that you were here, I must ask you the same question I tend to ask everybody else the first time that they're here. You ready?
Yep.
All right. I tend to look at today's entrepreneurs a lot like yesterday's superheroes. So if you think about Batman, Robin, Wonder Woman, Wolverine, etc., I can think of an entrepreneur occasionally, like we're flying around town, using our products and services, saving each customer one sale at a time. And yes, probably wearing cape and tights at that moment. However, also like a superhero, an entrepreneur has a beginning. There was a time where Spider-Man was just a kid going to school, doing his thing. Then one day gets bit by a spider, discovers he's got a special human ability. And now he has to choose whether to use it for good or for evil. So my question to you is as follows. Before Tower Capital, before, just get real estate, before being involved with ULI, before any of the things that you are currently doing today, what we want to know is, who is Adam Finkel?
Sure. Well, I'm just a regular guy from Boston, Massachusetts. Grew up there when I turned 18, headed out west, went to school at Arizona State University, where, when I was in college, I really didn't know what I wanted to do with myself. And I had some older guys in my fraternity, Sigma Phi Epsilon, who were in commercial real estate. It seemed like an interesting opportunity and got my foot in the door and, became a leasing broker actually while I was still in college. And when I graduated, I just hit the ground running. And that was kind of what led up to me, doing what I do today.
Interesting. Got it. So there was no real estate background outside of that. There's like no grandpa didn't do real estate, mom didn't do real estate. You just the frat brothers is where it came from.
Yeah, didn't come from, a big wealthy real estate family, didn't have any connections in the real estate world. You just went, sought an opportunity. I said, commercial real estate looks interesting. How do I get involved? They said, go get your real estate license and come back to us. Went summer going into my senior year, got my real estate license, went back, said, okay, I've got my real estate license. Let's go. They gave me an internship where I really was able to cut my teeth on the ground level and learn, the basics of commercial real estate, what affects landlords, what affects tenants. I got my hands on all different types of properties, whether it was office, retail, industrial, mixed use, and, mostly working on B and C properties, smaller deals, but a lot of transactional volume, which gave me great experience before I ended up actually hopping into the finance side of the business.
Interesting. I like that because there's something that you hit on that I've often said to people that oftentimes people want to talk about the dollar amount of deals that you've done. And I tend to care more about how many physical deals you've done because there's experience to be had when you're doing a number of smaller transactions that you just can't get all the time by just because you did a very large transaction. That may be in the only transaction you did that year. Whereas the person who, say, has 10, 15, 20 more transactions that year, it probably has a greater facility to be able to handle, more complicated issues. When it comes to getting involved in the real estate, what did you like? What was that transition like? Because here's where I'm coming from. You went to school, you went to college, but then you did something that doesn't sound like it's related to the fact that you went to college.
Well, yeah, look, I think that obviously investing in real estate doesn't need a college degree. It doesn't need a high school degree. Anyone can do it, which is the great thing. One thing that you mentioned about smaller deals versus larger deals is that I always recommend people to start small. Sometimes people come to me, they're trying to buy a 100-unit apartment building. They don't have the bandwidth, they don't have the net worth, the liquidity, they don't have the experience, and it can be very, very challenging. But when someone starts smaller, it's much more attainable. You get one or two under your belt, and then when you go to try to finance that larger deal, it's much, much, much easier. Lenders, they really want to see a track record. The first question I get asked is, who is the sponsor? What is their experience? Even more so than the deal. Mm-hmm. So people shouldn't be afraid to start small, get that, real world experience, because ultimately, that's going to make them a better investor, a better operator when they do pick up the larger deal.
One of the things that I would love to hear from your perspective, because I again, when I say start small, that can mean one thing. Or when someone is saying to themselves, "Yeah, I am starting small." When you say start small, like give us some sort of framework, either number of units, types of transactions, dollar amount, something, so that and people can have a frame of reference for what small means in your world.
Sure. Well, I started my career mainly focusing on more commercial properties, office, retail, industrial. Today, I focus predominantly on multifamily. Now, there's other guys in my shop that are doing all types of asset classes, but for me, I'm focusing on multifamily. And, many folks get their feet wet in real estate by buying single family homes and renting them out. And I have today some clients with massive portfolios. These people are worth $100 million. They have 5,000 apartment units, and they started with single family homes. So, what I tell people who say to me, Adam, I really want to buy an apartment building and I want to, get my feet wet, and they've never done any investing. I say, go buy a single family, go buy a rental property, go buy a condo, and get an understanding of what it's like to, go through the financing process, to, have a tenant, to deal with repairs. And then from there, they can, step up to a sixplex or a 12plex or a 50-unit property.
Now, how often do you have someone like get mad at you for saying that because they feel like, you know what, I'm ready for that 40-unit building I saw down the street right now, Adam?
Well, Jay, sometimes people have to learn the hard way. You can tell them all that you can tell them, but, I think what people find is that, again, it can be very challenging when you don't have that experience to go and buy a larger building. It's much easier when you start small. So sometimes, I can tell people these things, but then they go out, they learn for themselves, and then they come back to me and they say, Adam, you know what, you were right.
I'm glad we're having the same experience then. So you said you were in college. You were unclear about the direction that you wanted to go. So what was it that you saw that your frat brothers were doing or involved in that made you go, yeah, not just real estate, but specifically commercial real estate?
I think it was just about the time and the place that I was in, and just kind of, all of the stars aligning. I think that, had I been provided some other opportunity, maybe I would have pursued that. I'm not really sure. But commercial real estate at the time, this was in 2003, 2004. The market was picking back up again. And to be in a place like Phoenix that has had a tremendous amount of population growth, there was a lot of action, a lot of activity. So really just, going in, taking that chance. I knew that real estate, there's no better way to build wealth than real estate, in my opinion. And, I was given an opportunity and I took the bull by the horns and went out there and hustled and started my career that way.
Got it. Okay. Well, then let me ask a different question along the same veins. Now that you've been involved in real estate, specifically commercial real estate, for the time that you have, what keeps you there? Like, what have you discovered that you like about it that makes you go, yeah, you know what? I'll re-up for another year. Let's just keep going.
I just love working with people. I find it extremely exciting. The capital markets are very exciting to me. Dealing with the economy and, all of the events that affect, that you see in the news that affect the economy. It's really, really interesting to me. Commercial real estate and real estate in general, there's so many different facets to it. Like I said, you have multifamily, you have industrial, you have retail, you have all sort of subsectors within those. So I think, there's a real lot of potential for people. And sometimes, part of someone's journey is finding their niche, is finding what asset type do I like, or what position do I like to do within commercial real estate. Maybe it's not finance, maybe it's acquisitions, maybe it's property management or asset management. So, I think in life and anything, it's, allowing yourself to have exposure to different things to lead you to, sometimes you may not figure out what you like, but by finding out what you don't like, sometimes can lead you to what you like. So, what I recommend, for people to do is just really just try to get their feet wet, if an opportunity comes along, and then, just kind of take it from there and see where that leads them.
Yeah. Okay. So let's talk about that, where things lead, because where you've started, and then again, this is true for most everyone that I've ever interacted with real estate, is where you start isn't necessarily where you stay. And you've made this transition over to the capital side of the world. Tell us a little bit about what that was like and how that thought process evolved.
Sure. Well, I really wasn't even considering getting into finance. I had a really great commercial real estate career. I had been in the business for about 8 years. About 4 years after graduating from Arizona State University, I had moved out to Los Angeles. I had joined up with a larger regional tenant representation firm that's since been acquired by Cressa. And I was doing a lot of leasing on behalf of law firms, on behalf of physicians, doing a lot of surgery centers in Beverly Hills area. But I really didn't enjoy the tenant rep, leasing side of the business. I was starting to get burnt out. I moved back to Arizona, knew I wanted to remain in commercial real estate, and just started speaking with people, having coffees, having lunches, picking people's brains. And there was a gentleman by the name of Neil Cherney who ran the capital markets group for the Phoenix, Marcus, and Millichap office. He was also the former president of the Central Arizona chapter of CCIM, which is a commercial real estate organization. And he said to me, you know what, Adam, I'm getting busier. I could really use some help. Why don't you come over to Johnson Capital and come work with me? So in 2012, I joined up with Neil. He was a great mentor, taught me a lot. I started as an analyst, learned how to do all the numbers, how to underwrite, how to evaluate commercial properties. Then I got quickly onto the production side, and, really it just flourished from there. I had started my company, really the stars had aligned to start my company end of 2014. Johnson Capital was acquired by a larger publicly traded company out of Bethesda, Maryland called Walker and Dunlap. And that's really kind of when the stars aligned for me to jump ship, start Tower with my best friend since college. I've always had an entrepreneurial streak, and I really didn't want to work for a large public company. So I said to myself, I don't have any kids yet. If I'm going to take a chance, it's now. I went out, I started Tower Capital, and, we built up a reputation of executing for people and out there hustling. And, today we have 8 employees. We'll finance about $300 to $400 million this year out of our Phoenix office, both for all different types of real estate projects, whether it's existing, ground up, transitional, and, really just trying to grow the company. And everything has really happened organically, to be honest.
Well, that's good. That's kind of a great way to make all of those things happen. Tell us, if you will, some of the types of transactions that Tower Capital that you guys prefer, that you like. This is our bread and butter. These are the ones that we love to make happen for clients.
Sure. Well, we love all types of deals, and that's one of the things that makes Tower Capital unique, is that we're not solely focused on one particular asset type. So, we're financing all different types of assets in all situations, whether it's a stabilized property, a transitional asset in need of a bridge loan, or a ground up development project. Most of our loans are, a couple of $1 million and up. In fact, typically the larger loans actually end up being a little bit easier than some of the smaller stuff.
Right.
But again, as I said before, small deals can turn into large deals. And, we've grown as a company, and, we've also seen our clients grow as well. So, really what we do is we have a very collaborative approach. So, I handle most of our multifamily business. If it's just a stabilized deal already existing, we could be utilizing Fannie Mae, Freddie Mac, a bank, a credit union for that type of financing. For our hotel business, my partner, Kyle McDonough, handles most of that work. For our more highly structured deals where it's, a ground up, apartment building where, we're putting the whole capital stack together. That might be my other colleague, George Maravilla, who comes from a development background. So, all of our capital advisors have unique experiences, which allow us to provide, an excellent level of service, really, no matter what the situation is. I will say we don't really do too many owner user type properties. If you own a business and you're, looking to buy a building for your company, we don't do too much of that. Those deals tend to be a little bit on the smaller side. We also aren't super involved with the very large institutional projects. We are a middle market company. We're working with small to medium-sized investors and some quasi-institutional groups. Mainly our bread and butter is the, $5 to $25 million transactions for the most part.
Got it. All right. Okay. So let me throw something at you that is kind of real, but real for me, that I'm curious to hear your response, because it's a mix of a lot of what you've just mentioned, and it's not clear cut in any one of them. For example, what we'll do is we'll tend to run a number of short-term rentals using, usually in my world, apartment buildings. So that could be for either from a purchase standpoint or what I like to call, it's not really a refinance standpoint, but that's what it feels more like, to where maybe we'll go in and lease the property for 12, 18 months ahead, and then towards the end of that lease, we would begin to look for our capital to then purchase that same building and continue operating it as a short-term rental. Now, sometimes in there, there's some rehab or reconstruction or even building new, but is that something in the realm of what you guys can play around? Hey guys, thanks for listening as always, and I'm glad that you continue to support with each and every download and subscription and share. One of the things that I want to ask you, though, is where are you listening to me from right now? I know some of you, maybe you're on a treadmill, maybe you're washing dishes, maybe you're walking that dog, and some of you are actually in a vehicle driving right now. One of the fun things that you can do, get some of your time back, is begin to living a car-free existence. But even then, it can be a little complicated. So one of the things that I want you to do is I want you to go over to Zipcar. Go to joinzipcar.com/CashFlowDiary. It's a way that I am able to still go get a car just for a few hours, very, very simply, so that if I have a lot of errands to run and sheets to drop off and running to the short-term rentals, or if I just want to go for a long trip up to LA and back, etc., I can rent a car for a very, very short period of time. And the cool part is I don't even have to pay for any gas. Again, go to joinzipcar.com/CashFlowDiary.
Jay, the short-term rental space is still a very challenging space when looking for financing, as I'm sure, you found out and you've realized.
That's why I'm asking the question.
Yeah, exactly. You and a lot of other people. And trust me, being in a town like Scottsdale, Arizona, where, we have our share of people coming to vacation, the Airbnbs and the short-term rentals is huge business where I come from. Yet it's very difficult to finance because it doesn't fit into any box yet. It's its own growing new asset class. But the lenders are still trying to figure it out because, when you have an apartment building, you have stability with, many lenders want to see, the majority of them 12-month leases, or, the lenders typically aren't going to want to see a bunch of month-to-month leases in there. They want more stability. And, as far as the hotels go, there's only, there's a limited amount of lenders that deal in the hotel space. And then they want to see, what type of flag is it? Is it a Marriott? Is it a Hilton? Is it an IHG? And so there's so many stipulations. So, the short-term rental, it doesn't fit in the box. Now, there are some lenders that you're starting to see. I know, one or two that have programs specific to the short-term rentals. I think over time, you're going to see more of that capital available, and especially when these lenders figure out how they can securitize those deals as well.
Right.
But, as of now, yes, it's, I wish I had a better answer for you, but they are very challenging to finance.
Well, and I knew that going in. I just wanted to ask anyway. But I also had the question, or at least the thought, that it sounds like one of the things you guys do over at Tower is you, for lack of a better word, you kind of play the middle, meaning you have to invest a significant amount of your time, assets, resources in finding sources of funds. And then you also spend time probably hanging around operators looking for, making sure that we know that you guys exist because we're the ones who have the funding needs, and you've got to be talking to both. And it would lend to, me to believe that you have alternative sources of capital other than just your Fannie Freddie stuff. And, I would assume you have relationships with, family offices, for instance. Am I close?
Sure. Yeah. I mean, we work with, what we really do is we get a full understanding of what are the needs of the investor, of the borrower. What is the type of asset? And we triangulate that with the capital source that's going to be the best fit, whether that is a bank, a credit union, Fannie, Freddie, HUD, a debt fund, an opportunistic private equity group. And within those types of capital sources, who is going to offer the best terms? And so, typically with the family offices, we're typically seeing family offices, at least I see them as being a more conservative, longer term type of investor. Mm-hmm. The debt funds are really who is providing a lot of the bridge money and more opportunistic money. Those loans are typically going to be higher interest only loans, but they're typically going to be on a shorter term scale. So, those lenders want to be in and out of the deal in, 2 to 3 years. Maybe some will stretch longer, but they also need to know, where is my exit? How am I going to be taken out of this loan? So we may have lenders, non-traditional lenders that like this space, that believe in the investor and the operator, that like the location. But then the question is, okay, well, if I finance this acquisition for this person, where is my takeout? Because right now, the banks aren't lending on them. And as we just spoke about, it's very challenging. So, that creates another hurdle for people with those deals. So, again, I mean, I think that over time, people are going to start to figure it out. It's a very excellent time to be a borrower right now. Interest rates are very, very low. They may be even going lower. A lot of these lenders have a lot of capital sitting on the sidelines that they need to deploy. It's not that they don't want to, because, that's sitting there burning a hole in their pocket. They need to put the money out to get their returns. But what we're seeing in this environment is that lenders are still having strict underwriting parameters. We really haven't seen things loosen up like they did leading up to the Great Recession. And so what we're seeing is that if a deal fits all the checks off all the boxes, it's a strong operator, it's a strong asset, it's in a strong location, you have so many different capital providers chasing those deals. And in fact, we've had bidding wars on some of our properties, which I've never seen before. I mean, usually, the investment sales guys who are selling these deals, there's bidding wars and the prices get bid up. In my world, we were financing a transitional apartment building. We went in for a $10 million loan request, and we ended up with $10.5 million for our client. So they were able to return some capital back to their investors, and they were very happy with that. So, if for a strong deal that fits the boxes, plenty of capital available. But yet, if there's one thing that's off, that's really going to limit the lending pool.
So you brought up a topic that I kind of want to look at for a second. It's the whole thing around interest rates, the economy. We've danced around it, and it's clearly, something that's affecting your business. When it comes to, and again, I'm not saying, what they're doing in Denmark is going to somehow happen in the United States with, negative interest rate mortgages, etc. But I'm just wondering, how sensitive is your business or the business of the commercial lending right now relative to, imports, exports, and everything else that's just kind of happening?
The capital markets are very complex, and you have a lot of forces at work, which can be difficult to wrap one's head around. And, you
That's
can
an
listen
understatement, my friend.
well, yeah. And you can listen to all these different economists, and they all have, varying opinions and differing opinions. And, I don't claim to know everything. And I think that when people think that they know everything, they usually don't. And so certainly the interest rates affect what I'm doing tremendously. And, right now, the reason why we're seeing so much transactional velocity in the marketplace is because interest rates are so low. And when interest rates stay low, that allows for people to, obtain a higher loan on their property. So maybe they can pay more. When interest rates start to go up, people's debt service payments start to go up. So that means that they can, afford less value of a property.
Mm-hmm.
And that's when you're going to start to see a lot of downward pressure on property values, because, no one's going to want to put down 40% equity on a deal. And so right now, with the rates being so low, people can afford to pay higher prices because they can still get decent leverage. And, so everyone is just kind of watching what's going on with the rates. And, we're seeing both short-term rates and long-term rates dropping. And so whether it's, you're going in to buy a stabilized, long-term investment, or a, shorter-term bridge loan, with the rates dropping, it's allowing for people to continue to, obtain strong financing and pay very high prices for the properties right now.
So, okay, with that thought process in the back, the question then becomes to me is, what about the mentality of the lender? Because there's a part of me that goes, well, that could be a risk off signal right there. If people are paying more than they probably should for a particular property, just because the interest rates justify it, or because the loan structures can make it happen, doesn't necessarily mean that you should pay that number for a particular property. Or is it more the risk off mentality, not necessarily connected to their interest rates as much as it is connected to the type of asset or the stage the asset is in? How is it normally looked at on your end?
Sure. Well, you brought up a few good points. First, I think everyone's very cognizant of where we are in the cycle. Certainly, we're very long in the tooth. While the American economy is strong, the rest of the world really isn't. And so, again, everything is really connected. Gosh, I lost my train of thought for a second, Jay. Why don't you go ask me another question?
I get that. I was thinking there's this butterfly effect of everything, because, I'm thinking from the lender's perspective, when you have people who are, lack of a better word, overpaying for property simply because it works, it's got to affect something. And me, as the one providing capital, I have to judge that risk appropriately and underwrite it differently. And I'm trying to figure out where do I make that difference? Because there comes a point at which maybe putting my money out there at such a low rate just doesn't even make sense. So maybe I change what do I change? How do I adjust for that?
Sure. Well, I think that the operator, the investor, there's a lot of focus on that person. Certainly, there are some inhibitions about where we are in the cycle. So there is some caution, yet at the same time, lenders have a lot of money that they need to put out. So just as I was saying before, for a strong deal, the borrower has a lot of different options. And, right now, where we are in the lending cycle and where we are with rates is that, the lenders, they're basically lending and they're off of a spread, and the spread is what they're making over their cost to borrow and what they're putting out. So, when the rates drop dramatically like they are now, we start to see the spreads widen out a little bit. So the lenders really aren't making any less money. It's really the people that are the savers that have money in the bank that, you're not making any money on your interest. But, commercial real estate loans, they're tied to all different types of indexes. The long-term loans are typically going to be tied to the 10-year treasury, which today I think it was at 1.68 this morning, if I'm not mistaken. The shorter term, call it bridge loans, can be priced over the 30-day LIBOR. Sometimes banks will price over prime rate, which I think is about 5.25. So, there's all different indexes, and sometimes the indexes can be affected up or down, and sometimes they're not. So just like I said, there's so many complex things at play. You would have thought everyone was thinking that, the 10-year treasury bonds would be going up and they're just dropping. I think partly that's a flight to safety because of everything that's happening, in the rest of the world right now. But, there's just a lot of things at play. So I think what people need to really focus on is, coming up with a good plan, underwriting with a little bit of cushion in their rate. The lenders on their exits, even though rates are very, very low, we typically see for multifamily, lenders, even if your interest rate is going to be, call it 4%, well, they might be underwriting at a 5% stress to see, what happens with that loan if the rates go up. Is their loan going to be able to be taken out if the rates are higher? So, it's a very, very fluid environment. The lenders definitely want to be putting out the money. They are proceeding with caution, but for a good deal, there's a lot of different options.
So from your perspective, would it still be now the time, for lack of a better way of putting, despite maybe even, because if I'm not mistaken, the curve is still inverted at the moment, yes?
It is. Portions of it are inverted. So, look, I think that when a lender is underwriting a deal, call it a multifamily deal, they're looking for it to hit a 1.25 debt service coverage ratio.
Right.
So, if a person is buying a property at, for a certain amount, the lender is going to underwrite based upon, today's rate and a stress rate. And, the deals are working because, we still have a very strong economy. We still have rent growth and NOI growth. So, properties are appreciating not just because of, low interest rates, but also, the fundamentals of the economy are strong, at least in America. Rents are going up. We have a balance of supply and demand right now. You may see a lot of, Class A apartment units going up in certain particular submarkets, but overall, there is a need and a demand for housing, and there's a demand and a need for office space and industrial space. And so, even with, rates low, that could potentially be putting, a kind of a false upward pressure on values. The underlying fundamentals are still pretty strong, which is leading to increased values as well.
Well, okay. So, and I'm assuming we're talking values on a nominal, not real scale.
What do you mean by that?
Well, because if we're just measuring, it's not like we're necessarily getting more building for the same dollar, or even more rent for the same dollar. If we're talking about rent growth, it's just, as that same apartment is, or that I was renting before, it is just getting more dollars, but those additional dollars aren't necessarily translating into me being able to do more with them.
Well, you have to understand, how is a commercial real estate property valued, right? It's valued based upon its net operating income over a capitalization rate, a market cap rate. So certain assets in certain markets are going to have, certain market cap rates. And, if your NOI is going up, then as your NOI goes up, the value will increase. And so, and that's exactly what we're seeing. So, the rents are still going. Here's a perfect example.
Yeah.
In Phoenix, I finance a lot of apartment buildings. There were a lot of these C-class apartment buildings were trading at, $20,000, $30,000 a unit, 5 or 6 years ago. Now the same apartment buildings are trading at, $100,000 a unit. And, that can be difficult for the local investors to swallow because they're used to, psychologically those deals going for, lower per unit. However, at the same time, when I'm underwriting these properties that are now $100,000 a unit, well, the NOI is also increased dramatically. So we are getting to those numbers, but, it's very tight. So, any dramatic increase in interest rates could really put a big pause in the transactional velocity in the marketplace right now. So, I think that it's very healthy. If the rates go down, that means someone can afford to pay, more. Yet at the same time, again, we're very long in the tooth in this cycle. So, for the people that are expecting, it's like, how much more can you keep pushing is the thing. So, right now, the loans, the lenders are still sticking to, their lending parameters. They don't want it to be above a 75% loan to value. They don't want, it to be less than a 1.25 debt cover. So the deals are working. Sometimes people are willing to take a little bit less leverage as well. We saw a lot of properties trading, 75 to 80% LTV. Now the in-place cash flows can only support about a 70% LTV loan in many instances, or sometimes less. So, there's a lot of different forces at work that you have to take into account, when analyzing these opportunities.
Yeah, no, totally understood. But at the same time, that what you just said is exactly why I think there should be more people willing to lend on my use case, because, to to say that we can hit a 1.25 debt service is a drastic understatement, and the amount of additional revenue that we're pulling in on a per unit or an entire NOI basis, especially once we start including the additional things that we can bring to the table, we're just not getting credit for the valuations that we're actually, or for the income that we're actually creating.
No, I agree with you 100%. There's properties where, multifamily properties where we have clients that set a certain number aside as vacation rentals. And, quite often those units are getting 30% more in rent, sometimes more. So yeah, it definitely can be much more lucrative. It's almost like one of those things where it's what's the highest and best use of the property, right? Maybe it is a short-term rental over an apartment. But at the same time, it's such a new industry that, look, lenders, they're very risk averse. So they really need to be able to figure out how they wrap their heads around it, how they minimize their risk, and, again, what is their exit? So I think that you are going to see over time that there is going to be more sources available. And, I think this year, I've seen a couple pop up, and I think that will continue.
Yeah, I'm looking forward to it. I'm definitely counting on it, because there are some buildings that we've been in now for a while that I'm ready to purchase, and some more that I would like to go acquire. So definitely looking out there for it. Now, for those that have listened this far and want to find out more about what you guys are up to, what's going to be the best way for them to track you down?
Sure. I would say visit our website, www.towercapllc.com, or they're welcome to give me a shout at 480-426-0576.
Excellent. Love it. 100%. I definitely want to say that I appreciate you, sticking to your values in terms of your company, what it is that you could have done. You could have gone larger, but you're sticking with what it is that you actually wanted to do. And that's not always the case with a lot of entrepreneurs. So this is good. And I'm just really appreciative of you, caring in the way that you do. Now, as we wind down, I have a final question for you because I'm I'm really curious to hear your answer. As you and I have been talking today and people have been listening, someone probably got to what I like to call the precipice of decision. It's where they, said, okay, that's it. Finally, Adam's here. Now I can do the property that I wanted to do. This, commercial building, this gas station, this thing that I'm after can actually happen. And they're like, all right, drawing that line in the sand, and they're moving forward. Now, like I know, that oftentimes when we draw those lines in the sand, it comes with a companion, and that companion comes in the form of a voice. And it's a voice that reminds us why it won't work, how it didn't work last time, and who am I to think that you could do a $20 million loan? And for some people, they're related to that voice. So my question to you is as follows. Let's pretend that this time it's going to be different, Adam. They're going to follow through. They're going to do exactly what you suggest. And they're going to do so in the next 24 to 48 hours. What would you suggest that they do?
I would suggest that they get their personal financial statement and schedule of real estate buttoned up and be cognizant of the lender's parameters, their underwriting parameters and what they're looking for. Typically, as just a very quick rule of thumb, when buying a commercial real estate property, the lenders want to see a net worth equal to or greater than the loan amount. And they want to see liquidity. That means cash in the bank of typically, at least 10% of the loan amount, 12 months of loan payments. So, if the investor doesn't meet minimum underwriting standards, then they're going to need to find someone that can come in with that balance sheet to help them acquire the size of the asset that they're looking to acquire.
Got it. 100%. I like how you keep it simple, how it's very clear, and you understand your market and your business. And I definitely appreciate you taking the time to share your knowledge, your wisdom, and insight here with us today at the CashFlow Diary, sir.
Great. Well, thanks, Jay. It's been my pleasure, and I wish you a great week.
All right, ladies and gentlemen, you know what time it is. It's time for you to move at the speed of instruction. What does that mean? That means, get over to towercapllc.com. That means call him. How often do you actually get the phone number? Well, now you have it. So that's an invitation. That's why it was left. So your job, as you have just heard, get that PFS, personal financial statement, in order. Put that balance sheet together. Make sure that you are ready to take advantage of this particular opportunity because, it will change. When? Who knows? But the way that it is right now, it's probably a good time for you to strike. Ladies and gentlemen, it's been fun talking to you guys today. I look forward to talking to you soon. Until next time.